Hey, welcome back. Nike stock is now close to some of the lowest prices in about 3 years, and I can see that many people have gained quite a bit of interest in them. But there are a few issues that I want to address later in the video. They made 6.2 billion last year, which would put them at a ratio of 22. It was much higher 1, 2, 3 years ago, but it doesn't mean this is cheap now. It was very expensive in 2021, for example, due to the pandemic hype, but now it's getting to a fairer value. We can see that North America represents a big chunk of the revenues, so there is potential to grow outside, especially in Europe. Now, something very attractive about Nike, the 24.75 billion in current assets is enough to cover not only the current liabilities, but the total liabilities. A bunch of them is in inventories, but even without that, they are still doing very well. The only issue I see is that you don't have that many long-term assets, but the value of the brand itself, for example, is not included in something like this. So overall I'd say they are quite good from a financial point of view. We can see that the debt is very well spread through the future, and not even the bigger years should come with a significant repayment. The interest rate is also very small, and there is nothing to be paid this year. Unlike Starbucks, which I talked about recently, Nike has the advantage of a very strong balance sheet, meaning that when they think about growth, they don't have to worry about the debt. And this is very important. They also pay a small 1.5% dividend and have a 4-year 18 billion buyback program started in 2022. I appreciate that they didn't do it in 2021 when the stock was at its peak. So the dividend is about 2 billion and the buybacks would be another 4.5 to 5 billion per year, meaning a return of around 5%. However, based on the company's cash flows, that's not sustainable. To be honest, 1.5% is nothing. I wouldn't even call this a dividend stock, but 2 billion for a company that's investing like a billion per year can make quite a difference. Now, this is a very competitive market with small margins and exposed to a recession. They have a very powerful brand, but the average person probably wouldn't buy too much Nike in a recession. So in a recession, as we've seen before, they can crash 30-40%, so keep that in mind. And in the long term, with so many brands developing, it's gonna be even tougher to maintain a good market position, so this is why I think that a dividend and even a buyback cut and focus on investing should be optimal. Think about it, they talk about growth so much, but how would they achieve it? A company worth 130-40 billion investing like a few billion per year in marketing simply can't grow too much. Having a good product isn't enough to guarantee growth. Instead of the high buybacks or dividends limiting the company, I think they should focus on investing even like 2-3 billion per year, buying other companies and developing into other branches, or buying a distributor and saving some money and so on. I'd be a bit worried because they don't seem to invest that much and the stock really depends on the growth. Yes, the buybacks will increase the earnings per share, but the company itself wouldn't improve. I looked into the transcript of the Q&A and they don't seem to have a clear answer. What does scaling newness and innovation even mean? Sure, there is air, but what about it? You know, I usually want to see them say we invest in this, then bring that into this market, and something quantifiable. I feel like all they say in the Q&A is just another form of marketing. But in this case, the stock is the product they try to sell to you. I don't know, maybe it's just me, but I don't feel too confident in the management. But it doesn't mean that they don't know what to do, it's just a preference for me. They talk about accelerating a multi-year innovation cycle with new products without giving too many details, but it has potential. If anything, this kind of innovation and especially marketing is what Nike is very good at. Again, the value of the brand and the know-how and everything aren't included in the balance sheet, and that value depends on what a company does with them. The growing population and with it hopefully an increase in the number of active people should also help. Another thing with potential is the focus on direct to consumer, because if they cut the middleman, they can increase the profit without having to sell more. Plus, this is much better from a marketing point of view because they can personalize the discounts and everything. You know, laying a clear picture of this would have been much better than scaling newness and innovation. Now let's get into a valuation for Nike. I think the classic 3 scenarios will be enough to get an idea about their potential. In a negative scenario with high competition and not a lot of growth, let's say they stabilize at around 4.5 billion per year. Now if they don't grow, the market would probably start to hate them, so let's assume a ratio of 12, which is relatively high but low for Nike. That's a market cap of 54 billion, meaning a price of 35.64, so a 60% loss. I think this is a pretty fair bottom to assume considering the brand value and the balance sheet. You get like 14 billion in equity and the brand should be worth probably even more than 40 billion, assuming that they don't deteriorate. But then, even 2.5 billion in buybacks is a yield of 4.6%, which in time can add quite a lot to the market cap. Or again, they can invest it and maybe generate some growth and maybe get some attention from the market again, so this price would have a lot of potential. In a second scenario, let's say they invest a bit and deliver some growth, getting to 5.5 billion per year. That should be enough to give the market confidence, so let's assume a ratio of 20. I know it's pretty high, but it would be probably the lowest in over a decade for Nike. So that's a market cap of 110 billion, meaning a price of 72.6, which is a 10-20% loss. So you can see that the current price is very similar, probably accounting for growth thanks to buybacks, but again, that's not improving the company. Now, in a good scenario with growth and market confidence, let's say they stabilize at 6.5 billion per year. For a ratio of 25, that's 162.5 billion, meaning a price of 107. So that's a 20% profit. Sure, the ratio can be like 30 again, but I'm trying to be a bit conservative. I know it's a bit ironic with a ratio of 25, but this is the stock. Now, with the buybacks, there is potential to get something like 120, 30, but I hope they focus on investing. And keep in mind that this is a very competitive market, and even if they have a strong brand, it's not enough to guarantee that they will do well. You can see that in the margin, which is relatively low. They also have very good financials, which is definitely a plus, and if they want to, they have the money to invest a lot. I'd say that at the current price this is better than Starbucks because even though both are very powerful brands, Nike has much better financials and they are valued relatively the same. However, given the big question about the growth and it not being so cheap, Nike is not a buy for me. I'd say that maybe something around 40-50 would be a good entry level, but the current price is not attractive. Maybe if I see them focusing more on investing, especially in the direct-to-consumer side and less on the buybacks, meaning the company instead of the stock, I'd be more interested. Look, they have a very powerful brand and they can still grow especially outside of North America, so there is potential. I just don't like what they seem to be focusing on right now. Plus, the price is not really attractive for me. Again, it depends on your targets and the reason why you invest. With the buybacks and dividends and a bit of growth, you can probably get like 8, 10, 12% on average, which isn't terrible, but I think there are better things in the market today. If it wasn't for the questionable growth, I think the current valuation would have been justified, but relying on buybacks to get EPS growth instead of improving the company is not good for me. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.